Welcome to the Deep Dive, the show designed to give you those aha moments,
Yeah.
especially when you're facing a huge stack of information and really just want the core insights.
Exactly. You want that quick, thorough knowledge, and that's what we aim for.
Today, we are diving deep into, well, the fascinating world of long-term value investing.
And specifically, we're looking at it through the lens of a particular firm called Right Tail Capital, LLC.
Right. So what are we working with here? What are our sources?
Yeah, so our material for this deep dive, it's a series of their investor letters. It starts with their welcome letter back in April 2022 and goes right up to their latest January 2025 letter.
Okay.
And these letters, they really give you this unique window into their investment philosophy, their whole process, and actually even the personal journey of the founder, Jeremy Kokemor.
Interesting. So our mission today is to unpack those core principles, that mindset they have, and maybe pull out some surprising, counterintuitive insights from these letters. We want to understand what makes this strategy really tick, and maybe more importantly, why it matters for you if you're looking to build wealth and, knowledge over time.
And maybe avoid some common mistakes along the way.
Absolutely. Okay, so let's start with the name itself, Right Tail Capital. It's intriguing. What exactly does right tail mean in finance? Why pick that name?
Yeah, it's a great place to start because it really cuts to their core philosophy. Basically, the right tail on a standard bell curve that represents the best possible outcomes, the extreme positive results.
The outliers on the good side.
Precisely. So for Right Tail Capital, the name is a direct nod to their mission, generating excellent long-term after-tax returns. They're explicitly aiming for those really strong outlier results.
Okay, that makes sense.
But what's really interesting, I think, is the personal layer the founder, Jeremy Kokemor, brings to it. He says the name also symbolizes continuous journeys of learning and improvement.
Oh,
And his background kind of explains this. His parents divorced when he was 6. And he talks about feeling those financial strains, his mom needing food stamps, relying on help from family and friends.
wow.
So that really instilled this deep appreciation for earning and saving. And then his first job, teaching summer school and middle school for like $3 or $4 an hour,
Yeah.
that also cemented the value of education and just continuous learning for him.
That's a powerful backstory. So this daily commitment he mentions, trying to be a better father, husband, friend, investor, healthier, all that, how does that, directly feed into making better investment calls? Is that, like Charlie Munger says, those who keep learning, keep rising?
Oh, absolutely. I think it directly informs the process. It's not just a nice idea. It builds a certain discipline, right? A mindset of constant improvement that just naturally extends to how they research, how they make decisions.
And probably how they handle tough markets, too.
Exactly. It builds resilience. If you're always trying to get better personally, you apply that same rigor to analyzing a company or deciding whether to hold through volatility. It makes that Munger quote feel less like a slogan and more like an operating principle.
Okay, so aiming for the right tail means focusing on higher quality businesses. But quality can mean a lot of things. What does it specifically mean for them?
They're very clear on this. It's not just a feeling. They need businesses with durable competitive advantages, moats that last,
Right.
high returns on invested capital, ROIC, and crucially, high returns on incremental invested capital, ROICIC. So how well do they invest new money?
Ah, that's key. The future growth potential.
Yes. And related to that, long reinvestment runways. Can this business keep putting capital to work at these high rates for like decades? That's where the real compounding magic happens for those right tail returns.
And management.
Oh, excellent management teams are non-negotiable. Absolutely critical.
Got it.
They also stress that these businesses sort of need to exist. They foster win-win relationships in their ecosystem. It's not about squeezing customers.
It's about adding real value.
Right, demonstrating great value for your customers. And they point out, if a business keeps earning less than its cost of capital, it's actually destroying value.
So it sounds like they're sidestepping the whole value versus growth debate. Is it really a blend? How do they make that work in practice?
It is absolutely a blend. They state clearly that both value and growth are incredibly important.
Okay.
The price you pay matters tremendously. That's the value part. And their assessment of intrinsic value, which they define pretty traditionally as the discounted value of future cash flows. That's core.
But the growth.
But the ability of that business to grow its cash flows, that has a tremendous impact on the intrinsic value and your potential returns. So You need both. A great business bought at a crazy price won't work, and a cheap, stagnant business won't get you those right tail outcomes either.
Finding that sweet spot.
Exactly, the intersection.
So how does this philosophy translate into, like, the actual portfolio? What does it look like?
It leads to a pretty concentrated portfolio, typically just 8-15 positions.
Wow, that's focused.
Yeah. The thinking is, first, it lets your long-term winners have a sizable impact. If you find a truly great company, you want it to matter.
Makes sense.
And second, it forces you, or allows you maybe, to deeply understand each company and its surrounding ecosystem. You're not spread too thin. If you can't really get your head around it, you probably shouldn't own it.
Deep knowledge over broad coverage.
That's the idea. And there's also this strong alignment piece. The founder invests, and I quote, "the vast majority of our family's liquid net worth right alongside the partners."
Skin in the game.
Very much so. And they even offer 2 fee options. One is a 0% management fee with a 25% performance fee over a 6% hurdle rate modeled directly on Warren Buffett's original partnership structure.
Interesting.
Or there's a more traditional management fee option too. But that first option really underscores the alignment. We win together.
Okay, we've got the businesses, the portfolio structure. But here's where it gets really interesting for me. Their mindset, especially that commitment to a 3+ year time horizon. Why is that time frame so critical? Why not 2 years or 5?
Yeah, it's fundamental to everything they do. They believe strongly that over that kind of time frame, 3 years plus, business fundamentals will be the primary determinant of stock prices.
So short-term noise just cancels out eventually.
That's the idea. Look, challenging periods, downturns, they're inevitable, right? But they don't see them as disasters. They actually view them as amazing long-term investment opportunities.
A chance to buy.
Exactly. A time to lay the seeds for future returns when others are panicking. It reminds me of that Morgan Housel quote they included. "This is the biggest market decline since the last decline you don't remember or care about anymore."
That puts it in perspective.
It really does. Market freakouts feel huge in the moment, but usually fade in importance over time.
In this long view, it obviously connects to compounding.
Absolutely. It's all about letting compounding work its magic. You know, Buffett's famous line, "The stock market is a device for transferring money from the impatient to the patient."
A classic.
And Naval Ravikant takes it even broader. All the returns in life, whether in wealth, relationships, or knowledge, come from compound interests.
So true.
They give a concrete example, too. Say you start with $1 million at 15% annual returns, which is ambitious but illustrates the point.
Yeah.
In 3 years, it's $1.5 million. Okay, nice. But in 10 years, it's over $4 million. And in 30 years, it's $66 million.
Ooh.
Right.
Yeah.
The length of time matters immensely. It's the power source.
That really drives it home. Now, the founder uses this amazing personal analogy.
Yeah.
Navigating volatile markets is like running in the rain. Tell me about that. What does that reveal?
I love that analogy. It reveals a lot about discipline and reframing difficulty. He says, look, running in the rain, yeah, it's uncomfortable at first, maybe miserable. But once you're out there, it provides a certain peacefulness, even increased clarity. It's about sticking to the process, maintaining a positive mindset.
How so?
By focusing on the process, finding good long-term investments rather than getting totally consumed by today's macro environment or the falling stock prices.
So the difficulty itself becomes focusing.
Precisely. The discipline required helps shed the stress and actually gain insight because it's hard, not in spite of it. It's choosing to embrace that discomfort and find the signal in the noise.
Wow. Okay, let's talk process then. The founder calls their research sausage making. What does that evocative phrase tell us about their approach?
Yeah, sausage making. It tells you it's probably not pretty, maybe a bit messy, but it's thorough and essential work.
Right.
It's about combining, as he puts it, qualitative and quantitative analysis from lots of reading, calls, thinking, and spreading numbers.
So the nitty-gritty.
Definitely. Reading all the filings, transcripts, talking to people in the industry, competitors, former employees, customers, and crucially, drawing on this library of prior research they're constantly building.
That accumulated knowledge must be powerful.
Immensely. And there's this great anecdote he shares. He went to an annual meeting for a big, successful S&P 500 company, a major company.
Okay.
And he was the only fundamental investor there, the only one asking deep business questions.
Seriously, what does that say?
It says a lot. It underscores how much value they place on digging where others don't, finding that off-the-beaten-path information. Most people are just not doing that level of work anymore, maybe.
So insight isn't just one brilliant idea then.
No, not at all. It's not a silver bullet. He describes it as a mosaic, built from many little things pieced together over a long time.
Through hard work.
Exactly. Hard work, reflection, and constantly trying to broaden that circle of competence Munger talks about.
And they've looked at a wide range of industries.
Oh, yeah. The letters mention studying auto dealerships, contract research organizations, railroads, equipment rental, C-stores, payment networks, insurance, royalty companies, trucking, even pest control. It's about building that mental library of how different businesses work.
All right, let's make this concrete. Can you give us some examples of these right-tail businesses they've actually invested in and discussed?
Absolutely. Let's spotlight a few mentioned in the letters. First up, Ferguson Calas. They're a big U.S.-based distributor of plumbing and HVAC supplies. Think $23-33 billion market cap.
Okay, what's the edge there?
Well, they're in a prime spot in its value chain. You've got tons of suppliers, maybe 30,000, and even more customers, like 1 million, mostly small contractors. And their competitors are often tiny mom and pops.
So they have scale.
Huge scale advantages. They offer great service, parts availability, and because the stuff they sell is essential, they can generally pass through increases in prices.
Makes sense.
Plus, they sharpen their focus by selling off their European businesses to concentrate on the high-return U.S. market. That's led to really high returns on incremental capital, he says, greater than 30%. And a big chunk, 60% of their revenue, is repair and remodel, which is less cyclical than new construction.
Okay, interesting. Who else?
Another fascinating one is Constellation Software, founded by Mark Leonard. They buy and build niche vertical market software businesses. Think software that runs a specific type of factory or manages a specific industry process.
Mission-critical stuff.
Exactly, mission-critical solutions. Their track record is just eye-popping. Why? A super disciplined approach to buying these small software companies.
And the returns?
Exceptional. ROIC often over 40%, even accounting for intangibles. Customer retention is sticky, like 95% plus. And get this, dilution disdain. Their share count is basically flat since the IPO.
Wow, that's rare in tech.
Very. They even make employees use part of their bonus to buy stock. Talk about alignment. And recently, they deployed about $2 billion, including snapping up 2 larger corporate carve-outs, Optimal Blue and Empower from the ICE Black Knight deal.
At good prices.
Apparently very good. Less than 7 times EBITDA, which is, a measure of valuation. Compare that to the 30 times Black Knight originally paid for one of them.
Okay, quite a difference. What else?
How about retail? Ross Stores. The
Yeah.
off-price retailer.
The treasure hunt.
Exactly. Name brand apparel and home fashions at 20% to 60% savings. It's a win-win. Customers get bargains, and vendors get a discreet way to move unwanted inventory.
And probably does better when times are tough.
That's the thesis. Their value proposition likely increases during tougher economic environments. And historically, an incredible performer, up over 200 times since its 1985 IPO, not even counting dividends.
Incredible. Any newer positions?
Yes, Boyd Group Services. This was highlighted as their newest investment in one letter. They do collision repair. You might know them as Gerber Collision and Glass in the U.S. They own around 950 shops.
What's the play there? Consolidation.
Exactly. They buy and grow smaller repair shops, usually getting good returns on capital, like over 25%. The industry is super fragmented. 60-70% are single shop mom and pops.
Who maybe struggle with newer car tech.
That's part of it. Boyd has the scale in tech, plus they're crucial partners for auto insurers via direct repair programs. That's 90% of their revenue, so it's less tied to the overall economy. Car accidents happen regardless.
Right, any others?
One more pair they mentioned, treating almost like a single position. CDW Corp and Insight Enterprises. These are IT solutions providers.
Tech resellers.
Kinda, but more like outsourced IT teammates for small and mid-sized businesses. The IT market is incredibly complex, right? Over 100,000 products, 1,000+ brands.
Totally bewildering for a small business.
Exactly. So CDW and Insight act as this valuable agnostic partner, helping companies navigate it all. They sit between fragmented vendors and fragmented customers, which leads to pretty superior financial results and high incremental returns, typically above 30%.
Okay, that's a great range of examples. But investing isn't always smooth sailing. What happens when things go wrong, when an investment thesis breaks or there's a difficult message? How do they handle that?
Yeah, they addressed this head on with their decision to sell Charles Schwab back in March 2023, right in the middle of that regional banking crisis.
Ah, okay. What was the thinking?
Well, several things. Schwab is technically a bank, right? It invests idle client cash, and a lot of that was in bonds that lost value as rates rose.
Right, the duration risk.
Exactly. Plus, clients were starting to move cash out of Schwab to get higher interest rates elsewhere. So there were concerns Schwab might need to raise capital or face tougher regulations.
So they lost faith in the business.
Not entirely. They still called it a blue chip firm. But the core decision, as the letter puts it, was about where the founders' time and energy would be better spent.
Opportunity costs.
Precisely. Rather than spending time trying to untangle Schwab and figure out all the banking complexities, they decided to focus on finding the next great right tail investment. It fit their philosophy of repeat what works, focus energy on the highest potential opportunities.
That makes sense. Shifting gears a bit, beyond specific stocks, the letters talk a lot about mindset. This idea of the gap and the gain comes up. Can you explain that? How does it apply?
Yeah, this is a really powerful concept from Dan Sullivan, the strategic coach. The gap is basically measuring yourself against some future ideal.
Like where you should be.
Exactly. And the problem is the ideal always moves. So you always feel like you're lacking, falling short. It can lead to, unhappiness, lack of confidence.
I can see that. So what's the gain?
The gain is looking backward and measuring your progress against where you used to be, recognizing how far you've actually come.
Celebrating the progress made.
Right. It fosters a much happier, more confident mindset. And Sullivan argues, and Right-Tail seems to agree, that being in the game actually makes you more likely to achieve future gains. It's about progress over perfection and actively training your brain for positivity.
And they apply this to their investing.
Seems so. Both in evaluating their own performance and just maintaining resilience through market cycles. Focus on the progress, learn from mistakes, but don't live in the gap.
That's a great mental model. And it seems linked to their emphasis on continuous learning from others, from the masters.
Absolutely. Charlie Munger's influence is huge, clearly. The founder quotes him constantly.
Like what?
Things like, spend each day trying to be a little wiser. The idea that it's an absolute necessity to read all the time. Munger's famous line, in my whole life I have known no wise people who didn't read all the time. None. Zero.
He was emphatic about that.
Totally. And another key one for investing. The big money is not in the buying and selling, but in the waiting. Patience. Letting those great businesses compound.
So reading is central.
Yeah.
Any specific recommendations they shared?
Yeah, they sprinkle them throughout the letters. One he called an undiscovered gem is $1 at a time, an insider's account of how Dollar Tree remade American retail.
Okay.
Others mentioned what I learned about investing from Darwin, Robert Caro's book Working, and even The Inner Game of Tennis.
Interesting mix, not just finance books.
Right. And they mentioned timeless podcast episodes, too, from people like Tim Ferriss and the Founders Podcast. It really shows this commitment to learning from diverse sources, constantly feeding the mind.
It really paints this picture.
Yeah.
This commitment to consistent, small improvements. The daily habits, running, meditating, reading, how does that compound? Not just for investing, but maybe for everything, leading towards those right tail outcomes in life.
That seems to be the underlying message, doesn't it? That the principles are universal.
Well, this deep dive into Right Tail Capital's letters, it really feels like it offers much more than just financial advice. It feels like a testament to a whole philosophy.
Yeah, long-term value creation rooted in that deep research, that unwavering patience, and maybe most importantly, that commitment to continuous growth, both personal and professional.
We definitely saw how that disciplined approach, like his running in the rain analogy, can really turn challenges into opportunities.
Mm-hmm. And how focusing on the gain, not the gap, can just shift your whole perspective on progress and keep you moving forward.
So maybe the question for you, the listener, is what right tail outcomes are you cultivating? Not just in your portfolio, perhaps, but in your learning, your skills, your relationships.
Yeah, what's that one little thing you could do consistently starting today?
That small daily action that, through that power of compounding we talked about, might just grow into something truly beautiful and significant over the long term. Something to think about.